Thanks for joining us on Trending today. I'm Nivita Ganguly, and this is what we have lined up for you over the next 30 minutes. On the agenda today, we discuss market trends and expectations with Girish Pai, Head of Institutional Equities Research at Nirmal Bank. Jewelry counters have been shining. To understand the reasons behind the recent rally and really get an outlook for the business, we speak to Sanjeev Bhatia, Chief Financial Officer at PC Jeweler. And we connect with Upasna Bhardwaj, Senior Economist at Kotak Mahindra Bank, to understand GDP expectations and discuss the S&P's rating outlook on India. But let's first take a quick look at how markets are trading at this point. Nifty trading flat with a negative bias about, it's in fact trading in the negative, about 0.3% of a cut coming in at this point. It's trading at about 10,350, and really the sectors that are contributing to that, I'll just quickly take you through that. We are seeing the bank Nifty come under some amount of pressure, trading with declines in line with the benchmarks, down about 0.3%, with both PSU and private banking counters coming under pressure. The PSU banking pack, in fact, is seeing cuts of 0.8%, down nearly 1% at this point, with nearly all its constituents trading in the negative, with the exception of Indian Bank, which is trading with gains of 0.6%. But Syndicate Bank, OBC, Andhra Bank, all of them seeing cuts of about 1 to 2% in trade at this point. But the top gainer on the Nifty at this point is UPL, followed by ONGC, NTPC, Aurobindo Pharma, Z Entertainment, L&T, Vedanta, Lupin, Eicher Motors, and Tech Mahindra doing well in trade. All of them seeing gains between 0.5% to 1.5%. But on the losing side, it is HPCL that is the top loser on the Nifty at this point, seeing cuts of about 1.5%, followed by an IOC, Bajaj Finance, IndusInd Bank coming under pressure. This counter seeing cuts of about 1%. Adani Ports, BPCL, along with HPCL, also losing out. And we have Tata Steel, HUL, Power Grid, and Infosys ahead of its buyback. That is, of course, coming that kicks off later this week. But let's quickly, put the focus on the markets. Where are markets headed at this point? Is it a good time to enter the market? Well, to answer these questions and really understand the current market trends, we're now joined by Girish Pai. He's the Head of Institutional Equities Research at Nirmal Bank. Girish, thanks so much for joining in. Very good to have you on the show. With the second quarter behind us, first off, let me ask you, what were the main trends that you saw this quarter? And looking ahead, what are the cues that you're watching? We have, of course, the Gujarat elections, also have the FOMC meet. RBI will come out with its December policy. What are you watching out for?
Yeah, so we believe that markets are going to trend upwards. I think it's going to be trending up based on the kind of earnings growth we're going to see at the index level. So we've had, last few years, we've had a situation where the macros have been fairly good, whereas the micro level situation on the index earnings side has not been as good. But we kind of seeing a probable turn in that. We've seen a situation where these two things have kind of reversed. So macros are looking a tad weaker than what they were previously, whereas earnings, I think, have kind of started picking up. So except for a few pockets of the market, like say PSU banks or maybe some private corporate banks and say the pharmaceutical sector and certain other pockets of the market, I think broadly the earnings have been better than expected in 2Q, and I think that trend is going to continue going forward. So it's a combination. So that's a cue that we've been waiting for many quarters now, in fact for many years. So we had a situation where index earnings have been growing at something like 5-6%, and we think that that kind of trend is going to kind of break out and go into, say, high teen kind of territory in FY19, considering the base we'll probably see in FY18. So earnings are probably going to be a big driver. I think the immediate cue would be election results in Gujarat. There have been some concerns whether BJP would be able to maintain its current seat share there. If it is able to do that, or if that increases, my sense is the market will take it positively, and it will probably assume that a 2019 verdict at the Lok Sabha level will probably be in its favor. So, positive impact on political stability, all that it's going to play out. I think globally, I would think that risk appetite is fairly high for equities if you look at the way global equity markets have been functioning. So all those combined, I would think that markets are headed higher, though from a valuation standpoint, I would say it's on the richer side right now.
All right, on the richer side right now, we're definitely looking at an uptrend going into the end of the year. But Girish, rural recovery was a big theme. If you look at the second quarter results, all the consumer-facing sectors really performed well on the back of rural demand seeming to come back. What do you make of that at this point? What are the sectors that you would be betting on to really ride this trend?
So as I mentioned, I think 2Q numbers have been, except for certain pockets, I think have been better than expected, and especially those which are focused on domestic consumer-facing areas, I think have done better than expected. I think 2Q had a situation where you had GST-related restocking. The festive season was kind of brought forward in 2Q compared to last year. So that led to a base effect playing out from a volume growth and a revenue growth standpoint. So that surprised. I think the biggest surprise was probably on the EBITDA margin front. I think because of a richer revenue mix, where there was premiumization, a lot of companies in the revenue mix side, better cost controls, and probably some input tax credit being retained by companies because of GST has all contributed to a better EBITDA margin than I think the street had anticipated. So we got a, I think the operating profit growth, EBITDA growth was definitely better than what the street was expecting, and that has contributed to a better profit growth. So I think going forward, we don't want to take any big sector calls. I think as I said, I think the valuations are reasonably rich. I think they are probably at about one standard deviation higher than the mean as they stand currently. And I would think that one needs to be selective in the kind of stocks that one wants to get into. So we are selectively positive on financial stocks, selectively positive on consumer discretionary stocks, selectively positive on auto companies. Where we do not have too much of comfort as one IT services sector, we are fairly positive on pharma from a 2 to 3 year standpoint. So broadly, that is the kind of a picture we would want to kind of carry in terms of investing in the various pockets of the market.
All right, you mentioned pharma, Girish. We're seeing these on and off rallies in this space. US FDA clearances seem to have sped up, at least looking at the way they've been coming in the past. Do you see valuations looking attractive at this point?
I didn't catch you.
If we talk about the pharma sector, we've seen these on and off rallies here, and with the kind of news coming in from the US FDA front, do you see valuations looking attractive at this point? You mentioned a 2 to 3 year time horizon. Is that how long you see it? So is this now a good time to enter for pharma?
Right, so it's a contrarian call. It's a bit of a risky call, I would say, as things stand right now. With the kind of news flow we've seen over the last many quarters, we've had a lot of compliance related issues with various companies with US FDA. We've had, I would say, a little higher than expected pricing pressure in the US because of consolidation on the buyer side. Having said that, we think that a lot of pharma companies have got fairly decent product pipelines in the US, and some of them are in categories like injectables and complex generics. Which I think if they kind of play out as anticipated, we would expect a fairly sharp earnings rebound starting FY19 and going forward. So I think I would want people to take a slightly longer term view on this sector. The sector has gone through both an earnings as well as a PE multiple contraction. I would probably think that both will reverse as we see earnings kind of come back on the back of some of these molecules actually going out to the market and generating revenues and profits for these companies. We think that's going to happen starting FY19, or at least that's what my analyst believes. So we expect a fairly sharp rebound in earnings starting FY19, and we think that this is a sector you probably need to take a 2 to 3 year view, because I think in the interim you will probably continue to see news flow which could be a little adverse. I mean, we could probably see further compliance related news flow which could trouble the sector, which could lead to volatility. So I think you need to have a bit of I would say, a strong stomach for investing in this space. So, and you need to take a slightly longer term view. I think a 2 to 3 year view could potentially lead to, I would think, a much better than market related returns on this particular space. So that's our call on this sector.
All right, need a stronger stomach to enter the pharma space with a 2 to 3 year time horizon. Girish, also want to get your view on the IT pack, because the sector did well actually last week, not just the frontline names, also the mid caps as well. We have these two massive buybacks lined up at the end of the week. We have Wipro and Infosys altogether about 24,000 crore value buybacks. How do you see this space really playing out over the longer term?
So we have been bearish in the sector for a fair bit of time, almost 3 years thereabouts. So, we continue to believe that fundamentally growth in the sector is going to be fairly tepid. We think that revenue growth for the tier one IT services firms would be in the 5 to 7% kind of range in US dollar terms in the foreseeable future. I would say between FY17 and FY20, that's the kind of growth we're expecting. We think that EBITDA margins should kind of trend lower as costs kind of build up in US and other developed markets as these companies recruit more locals than they used to do in the past. And I would think that even if there is some bit of rupee depreciation, my sense is that the kind of earnings growth we're going to see in the sector for the top tier companies would be in the very low single digits on a CAGR basis over the next 3 years. I'm talking about FY17 to FY20. So fundamentally, I don't think there's any case for investing or taking a very large bet on these stocks. I think the only argument that one has in favor of these companies is from a valuation standpoint. I think valuations are looking, obviously, had looked, I would say, fairly low compared especially to the much loved consumer space, including autos, or if you look at financials or discretionary. Some of those companies have been coming at fairly steep multiples. So against these much loved spaces, I would think that the valuation differential had kind of expanded quite a bit over the last 12 months or maybe a little longer than that. So I think what we're probably seeing is a little bit of money moving away from those much loved areas into IT service. I think it's a valuation trade at play, which has probably led to the stocks kind of moving up recently. Obviously, the buyback has been fairly strong for some of these companies. That's also been a trigger. Besides that, I don't think there is any structural or a multi-year kind of growth story kind of building up there. I would still think that growth is going to be fairly tepid. So we still continue to be negative on the space. We still think that earnings growth is going to be fairly low. We think that number is going to be in the low single digits for the tier one companies over the next 3 years.
All right, low single-digit growth for the tier one stocks in this space. Girish, we'll leave it at that. Thanks so much for joining in. Always appreciate your view on the markets. That's Girish Pai of Nirmal Bang. But let's put the focus on some stock-specific action now. PC